This episode is all about finances.
There's too many gyms going out of business. There's too many personal trainers that aren't successful financially.
Now, don't switch off. Finances is the most important part of your business, but typically it's the part that most fitness business struggle with. But actually, that's the reason why most fitness business owners aren't as successful as they like to be, because they don't have a good understanding on their financials.
The time they spend on their business rather than in it should be the bulk of their time. The ones who've really made it, they're the ones that spend all their time on the business and not in it.
And in this episode, if you're one of those people that find financials confusing, don't understand the general terms or lingo, this is the episode for you.
The UK has the biggest tax code in the world. It's quite easy to make a mistake on it.
If you've ever thought you have some stupid questions about finances, don't worry. We're going to ask all of those for you in this episode with Duncan Lloyd from Cloud Accountant, who is a profit-first accountant. He's actually our accountant at FMA, and we recommend him to our clients with his profit-first principles. Again, running a business is hard. Understanding financials is hard. In this episode, we're going to dumb it down and make it as clear as possible for you to understand of how to actually structure your business financially for success so you can have the most profitable fitness business possible. We hope you enjoy the episode.
Duncan, welcome to the Fitness Marketing Agency podcast. I first came across the book Profit First a while back, ignored it. COVID happened. I was running every day doing those 5K challenges and popped that book on Audible, started listening to it from Mike Mikowski. Loved it. And then at the end of the book, he said, go to a website to find Profit First accredited accountants. I did that and I found you. We had a quick conversation and you've now been Fitness Marketing Agency's accountant for 2 years. So thank you very much for all of your help helping FMA. You now also work with a number of our clients at FMA, and I wanted to get you on the podcast just to talk all things accountancy, profit, running a business, running a gym. So let's go way back. When did you qualify as an accountant, and then how did Profit First come into your life?
Well, first, thank you for having me. I qualified unbelievably 23 years ago. I worked for a big firm, big multinational accountancy firm, a great firm to get that education. I held a number of finance director positions, but it soon became quite clear that I was not cut out to work for someone else. I had to work for myself. So I set up Cloud Accountant with a business partner, Gareth, and we set out to be, I'd been on both sides of the fence and I knew what clients needed, and I thought, well, we're going to do things differently. And I think we were doing a pretty decent job. And then one of my clients recommended a book to me, Profit First. And I'll also be grateful to Paul for that recommendation, because it was absolutely life-changing read for me. And reading it, I could see how it would really help our clients. And so previously I've been, like I say, I think we were doing good things for our clients, but I could see how we actually were missing a trick. So sort of rather humbled, actually, I kind of pivoted how we serve our clients. So we implement the Profit First approach. It serves clients really well, and thank you for being a client. I think the system works well in your business, because you're an entrepreneur. You understand cash. Entrepreneurs, that's their language, and it's our job as accountants to talk the language of our clients.
I've always been really good at making money, not so good at keeping it. And as my entrepreneurial career in the fitness industry evolved, I would very easily grow and scale businesses and be focused on revenue. And I think as a personal trainer, a former personal trainer, fitness business owner, and now obviously running fitness marketing agency, sometimes I would be so focused on growth that I would ignore the P&L, I would ignore the finances. The accountancy company I was working with previously, I just met them when I was like 19 years old. They were my accountant then, and then they stayed my accountant for the next 10 years. And I was frustrated with them because I was the one always chasing them. And then when we would have a conversation, I really didn't get anything out of that said conversation to help me with the business and making profit. And there'll be sometimes in my fitness business where I'd have really good months on paper, and then I look at the bank account, it's a completely different story. And then from that, you stress, you go to bed, you're worried about it, wake up the next day and you think, what am I doing wrong? And this is why I'm so excited to introduce you on the podcast, introduce you to the FMA community and the wider fitness industry, because the work that you do with everything to do with Profit First is crucial to everyone in this industry. So there's too many gyms going out of business. There's too many personal trainers that aren't successful financially because, none of us got into this industry because we have a financial background. That's rare. We all got in this industry because we just have a love for fitness and helping people. So getting advice and help from someone like you is crucial. So my next question is, you, I believe you went to America to meet Mike, and how did that, the author of Profit First, how did that evolve?
Well, I love the system. I was making sure that all my clients got at least an element of Profit First in what we were doing for them. Working with fitness companies, by the way, is great because fitness people are just so giving. They just really want to help their clients, but we want to help them help themselves, so they can help more clients. And so with Profit First, I realized actually there were what you call territories around the world. So there's a US territory, a Canadian one, where there's a coherent license running, coordinating a number of accountancy firms, and there wasn't one in the UK. And I thought, well, I need to do that. That's got my name all over it. So I flew to New York to see Mike and had a coffee with him and said, I want to bring Profit First to the UK. And I thought there would be a queue of people ahead of me and I'd have to negotiate hard for it, but I was the first in the queue. So I think that says a lot really about opportunity. You just got to take it, and if there's a good opportunity, stick your name on it and take action. Again, it's another thing that we tell our clients: take action, do stuff. Which again is what they're telling their clients. There's so many similarities between running a good fitness business and what they deliver for their clients. So myself and my business partner, we now run the license in the UK for a number of accounting, bookkeeping, and coaching firms. And we're busy putting on events and getting the word out there.
Which many accountancy firms, they're not looking at the profit, and they're definitely not coaching or helping their clients to understand the P&L and advising them. And it's a very simple thing from the Profit First method is, open up the numerous bank accounts to direct funds into them. So can you just explain that to everyone who's maybe not familiar or if they haven't done it? Because one of the biggest takeaways everyone listening or watching this podcast should do is the multiple bank accounts. Can you explain that?
100%. Yeah. So the methodology is to open up 5 bank accounts. We call them the foundational bank accounts. So income, profit, owner's pay, tax, and operating expenses, or OPEX. And so money's going to come into your income account, and then typically twice a month. I mean, you can set the interval that suits you, but weekly or twice a month is typical. Money gets moved from the income account into the other accounts on a pre-agreed percentage. So the first of those accounts is the profit account, and that's not an accident. The purpose of a company is to make a profit. So we're saying, okay, that's the first account that gets some money. That's a really important psychological step to get in the right mindset. And then what you're left with is, once you put money in the profit account and the owner's pay account, so you're getting properly paid, regularly paid every month. You're left with the amount of money in the operating expenses account, which you've got to run your company on. So that smaller amount of money focuses your mind on getting value for money, on frugality, on innovation, on whether you've got enough money to recruit a number of staff or get bigger premises. If you had all the cash in one bank account, you risk being diluted by that cash into how your business is really performing. So we're kind of trying to strip all that away, build these solid habits that give you a smaller amount of money to create that deliberate tension to make you really analyze your company, keep your margins tight, and also identify problems as and when they happen and not 6 months down the line.
I remember back in my fitness business, you see 5K sitting there, 10K sitting there, 15K, 20K. You think, we're doing really well. Yeah. And then, you get a couple of invoices, you have to obviously pay yourself, and you pay some tax, and you get another HMRC letter, and suddenly, you're looking at an overdraft maybe, or it's a very minimal amount. So do you help your clients with that in terms of the distribution of the finances?
Yes. So all our clients are on Xero software. So we've got access to their bank feeds. So we will analyze the activity twice a month, and then we'll reach out to them twice a month and say, these are allocations you've got to make. This is what it means for you. So if there isn't enough money in the OPEX account, and that day will come, by the way, we tell our clients, just brace yourself, because this is not going to be a comfortable ride. But actually, that's a good day, because when that happens, that's them getting real-time useful information about what's going on in their company, and they can take action. And moving by 1 degree now makes a big difference in 6 months' time. Whereas if you don't know about it, problems can get worse and worse and worse. And then you get that point where you think you're doing well, actually you haven't got the cash, and then you've got the sleepless nights. We want to avoid that. We want to see it off.
Yeah, and I've definitely had those. So the goal is to obviously build that profit account nice and to a good level. Are you in communication with the clients in terms of like, hey, this is what I need as a take-home salary, and then you're advising them like, hey, this is what you need to put VAT, this is what you need to do for corporation, this is what you need to do tax.
Yeah, we tell them exactly how much cash to move. So twice a month I get an email from us saying these are the allocations, this is how much cash you should move. We also do a forecast for the year, so we know how much cash they should have at the end of each month, and if there's a variance there, we're on it. That's part of our monthly conversation, part of our coaching to make sure that they stay on track.
I remember, I get those quarterly emails from my accountant. Oh, hey, you owe 15,000, 17,000, 18,000 VAT. I'd be like, quickly call them up and be like, are you sure? Like, can you double check it? Like, I don't have that money here. And they're like, well, why don't you have the money? And I was like, well, it's been spent.
Yeah.
Oh, you need to save that. And it's the communication of like, and the panic, and and then you quickly have to like hustle, and any business owner, entrepreneur quickly sell some stuff to like raise the money. And it's just like that consistent, you're trapped in that hamster wheel, just consistently just going round and round. And it's hard to get out of it if you're not being advised strategically on your taxes and your VAT and making profit, which is what it's all about. I think too many people in the fitness industry, sometimes they're running their businesses like charity, and they're not a registered charity, and meaning like their prices might be too low, they're not generating enough revenue, and then they're making like minimal profit, but at the same time they're working 12, 14 plus hours a day to help people, but they're not really helping themselves financially. And 10 years passes, 15 years passes, and you turn around and you haven't really created anything of substantial, wealth or anything to potentially sell, because all you've done, has been stuck in that hamster wheel without any guidance and support. So it's like people like you who can offer that and help people. Let's talk about VAT. So what we see, and this is obviously applicable just for our UK audience, but in other countries they have their own, a tax to the government. So I'm sure other people can pick up on what you're about to say. But what we see, you're a successful personal trainer, you're under the VAT threshold. You gradually transition to running your own fitness business, and then you're taking in more money, and then suddenly you surpass that figure, and then you need to obviously start charging VAT or paying VAT to the VAT man. Can you just break this down as simple as possible in the UK?
Sure.
What is the VAT like levels?
So the VAT threshold is £85,000 on a rolling 12-month basis. So as soon as you hit that, I mean, technically, if you think you're going to hit it, the business has to register for VAT.
And how much of a percent is that?
So VAT in the UK is 20%, standard rate. But there's a couple of levers that we can pull to kind of smooth that out. So when a company first registers, you can go on what's called the flat rate scheme. So I won't go into details of that now, but that would help to smooth the transition from being non-VAT registered to being VAT registered.
And one of the biggest mistakes that we see is the gyms or the fitness professional not charging VAT on their prices to consumers. Can you just give some insight into that and what you see?
So as soon as you hit that threshold, you have to charge the VAT. So if you're charging, let's say, £100 a month, the moment you are required to be VAT registered, even if you haven't billed the VAT, HMRC want their VAT, so you actually get 20% less. You're taking a big pay cut. You have to account for that VAT by hook or by crook. So you do have to charge it to your clients.
One sticky point that people get confused on is, do they charge, let's say, £100 plus VAT and position it like that to the consumer, or they just say, hey, it's 120 quid?
I think they should always charge the £120. You know, consumers don't care about the price plus VAT. They just want to know what the money going out of their account is. And it's for you as a business owner to deal with that and make it smooth for your customer.
And I'm sure fitness business owners, gym owners, fitness professionals, they hear of all these like schemes, my friend who owns a gym down the road, he has 5 limited companies and he spreads the income across those 5 companies to avoid going over the VAT threshold, or my other friend who owns a gym, that they're over the VAT threshold, but their accountant did something and they don't pay VAT, and all this hearsay. In your experience, what ends up happening to those sorts of individuals or people with that mindset of trying to avoid paying VAT?
Sure. I think with people with that mindset will limit their growth because they'll spend a lot of time playing the tax game. They're trying to game the system. They're trying to not pay money to the government. There's a place for tax effectiveness, but actually your most important job running a company is the commercials. It's building a long-term profitable business, and the tax is the tax. And if you invest your time and effort in gaming the system, you're not investing your time and effort in building great products and employing great staff and developing great marketing. It's a wasted opportunity, and the companies that play that game will never be as big as the companies that say, here are the tax rules, we're just going to build a great company.
Because we see it like, I've got like 10 people that pay me cash, and then I've got 10 people go through my limited nutrition business, and then 10 people go through my one-on-one PT business, 10 people go through my group boot camp business, 10 people go through my advanced consultation therapy business. Like literally it's like crazy. Like I don't know how they keep up with it, with managing all of the books and the finances and juggling all the payments in different accounts.
It's such a big mistake, because if you get it right, you actually get paid 3 times, right? If you build a great company, you get paid a salary, you're building a profit, so you get a dividend, and then you're building long-term value in the business, right? So you get a nice big payday down the line if all goes to plan, and that's the aim of a lot of entrepreneurs, right? If you don't play it right, you just get paid a salary. That's all you get. If that's what you want, okay, you can do that. We're probably not the accountants for you. Good luck to you. We want to work with the people who want to build something special and want to get paid 3 times.
Let's switch to salary and talk about that. And again, just go back to basics so everyone listening and watching understands. So someone comes to you and they say, like, this is my salary I'm currently paying right now. I have aspirations to get to here. But then you mentioned dividends. Can you just talk through to everyone sort of how that works, and then when those dividend payments are paid out of the profit account if that said business owner chooses to do
Sure.
that?
So as a business owner, you want to get paid a salary through pay-as-you-earn, PAYE. That's important for accruing your national insurance stamp, which is your right to a state pension in future. And it is most tax efficient to take a mix of salary and dividends. To be fair, the gap isn't as big as it used to be. 10 years ago, there were big savings to be made. The tax advantage has been squeezed now. So more and more entrepreneurs are just saying, I'll just take a salary. I'll live on that. And I might take a year-end dividend, but I don't particularly want a dividend every month. That actually makes tax paying a lot easier, even though you will pay a few £100s more. But again, those are the people who are more focused on the long-term commercial gain and are less focused on making a little bit of margin here and a little bit of margin there. That they're the ones who are really going to make it.
A number of FMA clients have successfully grown and scaled their companies to the point where they are not operational in their businesses. So they're not on the gym floor delivering the service. They're hitting 40, 50, 60K a month in reoccurring revenue. Their gyms are at like 25 to 30% profit. They're taking home a salary of say 5, 6, 7, 8K a month personally. So what do you see from the clients that you work with in terms of profit margins in the gym?
There's quite a spread of margins. You've got the firms like the ones that you mentioned there, they're kind of the top end, the 30, 40 grand a month who are getting well paid. And then we've got the ones who are just kind of going through the VAT threshold. There are good margins to be made if you get a number of elements right, and those elements are the commercial elements. It's the pricing, it's the group structure, it's maximising the capacity of your premises, and this is where being a specialist in fitness companies is so helpful because we get so much data on what's working and what the revenue per employee should be and who's getting the most sales, who's converting the most leads into sales, for example. And then we can share that expertise within the group. So we're trying to give as rounded a service as possible. So it's not just is your P&L balance sheet. It's this is what it means to your business. This is what other people are doing. This is where you are in the group. I think people like to know where they are relative to others. Actually, similar to one of their clients come to their gym who wants community. That's what we want to offer for our clients.
So community and accountability.
Absolutely.
And then you see what's working in the industry, the profit margins, and then from that you can get the information you need and make better decisions.
Exactly. And sometimes people think they're doing great, and then they realize how much better they could do, and that inspires them to go on to even better things. And I love seeing that.
In your opinion, how many hours sort of per week should a business owner be focused on their P&L, their finances?
What a good question. I think if I can rephrase it slightly, I think the time they spend on their business rather than in it should be the bulk of their time. The ones who've really made it, they're the ones that spend all the time on the business and not in it. So not delivering to clients.
Yeah. The terminology I like to use is they're not the chef in the kitchen cooking the meals for the clients in the restaurant. And they're out of the business. They're managing the restaurant. They're overseeing the restaurant.
That's it.
They're eating in the restaurant because they don't need to do anything in it.
Yeah.
And
they're welcoming the clients in and enjoying it.
Yeah, and that's we have aspirations as a company to help as many gyms get to that point, and we have many gyms that are doing that already, and they're running super successful, profitable businesses. So many people watching this or listening have come across the book Profit First. They consume it, they understand it, they like the principles of it, but then 3 months, 6 months, 12 months later, nothing's really changed in their finances. So how do you guide people to implement that as quickly as possible?
I think that for those kind of individuals, they're a bit like one of a fitness company's client who comes to them and wants to make a big change, but they just need to take the first step. And for us, that first step is to open a bank account and call it your profit account and put 1% in. The question to ask yourself is, can my business survive on 99% of the money coming into it? The answer is yes, it can. So in which case, put aside 1%. So open that account, and the last day of every month, just put in 1% of all the money that's come into that account. Don't do anything else. Do that for 3 months. Then make it 2%. Do that for 3 months. You'll have started a fantastic habit that you can then start to build on. But don't think you have to have the whole system up and running in the next week. You don't. You can get there in stages. A bit like fitness, you don't have to be an athlete. You just want to be a bit better than you were last week. So yeah, the profit account and 1% is my top tip.
So to make it super simple, I'm generating 10,000 a month for my fitness business every single month, 100 quid into the bank.
That's it.
3 months, I've got 300 quid, and we just go from there.
Precisely.
People listening or watching this, they've got a bank account. In that said business bank account, do they open multiple accounts with inside that main business account, or do they open a bank account with a completely different bank?
So if you read the book says to open accounts at different banks. That's how Mike has sketched out the system. Personally, I don't think you actually need to do that. I think the important thing is just having the 5 accounts. You don't just have them at separate banks, but you do need to have the accounts. What you can't do is hack the system and say, do you know what, I'm going to monitor the balances in my accounting software or in a spreadsheet. That's not going to work, because you'll end up deluding yourself. And actually the power in the system is that the bank account is black and white, real-time information. There's no hiding from it. You have to deal with that reality. So having that system to give you that data and have a really clear-eyed view on it is the power of the system.
So prior to meeting you, we just used NatWest, a bank in the UK, and we had all of our money just in that account. Now, what we have is NatWest, and inside of NatWest, we have 4 different accounts. And then we've also got banks with Tide, Monzo, and Sterling. And then obviously at FMA, we're taking in different currency, right? And we're moving money around. And I had the mindset of like, more bank accounts is more admin, more hassle, more time, and it's a distraction. But looking back, it's like one of the best things that we've done, because you put money into that bank account and you just forget about it.
Yeah.
And you know it's there because you see it on the tracking sheet. Obviously, I do know it's there, but getting into that habit of just like having profit as the main focus is awesome for us as a company.
Yeah, absolutely. And there's no additional bookkeeping, from your bookkeeper or accountant's point of view. And if you get resistance to it when you're talking to your accountant, I think that's a good response. There's no additional work. The effort is on the entrepreneur to set the accounts up. All the accountant or bookkeeper has to do is do the activity for different bank accounts. That's straightforward.
What's your go-to recommendation for a UK bank?
We like the challenger banks, Monzo, Starling, because they're so easy to set up. So, and my top tip, by the way, is if you want one of those accounts for your business, open up a personal one first, and then create a business account. That's a much quicker way of doing it. But Starling, in particular, they're doing great things. They're actually automating transfers they call it spaces within their accounts. But Monzo, Revolut, Monies, there are a good number of challenger banks. We actually advise our clients to have a challenger bank, one of these online accounts, and a high street bank. It's just useful having access to, you can't get, for example, overdrafts or a wider range of products from the challenger banks, and you might need them one day. So just having access to a HSBC or a Barclays account can be useful.
Let's talk about overdrafts and credit and loan. And maybe not so now, but a few years back, it's very easy just to quickly get 3K, 5K, 10K, 15K personal overdraft, depending on your salary, and then exactly the same in the business, but maybe even more because the business is generating more money. What's your opinion on overdrafts? Should they be used? Should people go and activate them? Should they dip into them?
I think if the commercial reality of your business is that you need one, then you should use it. But you should certainly have a plan to get out of it. Your business should make a profit, and it should have enough working capital, enough cash to fund its own growth. There may be an opportunity where you want to acquire premises or another company, and actually a loan or an overdraft is the right vehicle for doing that. But generally speaking, for trading, for paying your salaries, for example, if your business is having to use the overdraft, something needs to be sorted out.
Red flag.
Red flag, yeah.
Let's talk about acquiring loans. So a lot of fitness professionals, business owners in the fitness industry, they do one or two things. Some just go out and secure a loan and then build their dream facility, and then it's perfect from day one. Others will baby step it, and they'll buy 3K's worth of equipment, train clients for 6 months, then buy another 3K, and gradually do it because they didn't want to take on any debt. What is your viewpoint on securing debt, business debt, and loans?
I think that every situation is different. Of those two examples that you just outlined, my preferred one is the second one. Incremental steps, really working those assets to generate more cash and then buying more. That allows you to test ideas, and then you can change direction. Whereas if you go all in on an idea and it's not everything you thought it would be, you're committed, and you limit your options.
Let's talk about habits and finance. What are some of the best habits or tips that people can take away from this?
I think the first takeaway is the striking similarity between what fitness companies deliver to their clients and what we're teaching to our clients, to fitness companies themselves. And the first of those is the habits, as you suggest, that if you have a client come to your fitness business because they want to lose weight, you want them to achieve that and then keep the weight off. After a quick result and then going back to old ways of doing things, you want to drive permanent, high quality change. And that means, I think the answer to that is good habits. So with a personal training client, it's come to the gym three times a week. It's eating the right foods. It's getting enough sleep. It's drinking more water. It's all those kind of things which are not in and of themselves. None of them is revolutionary. But you put them all together, make it nice and simple, and they just happen. And you as a personal trainer, that person's going to get a result. Similarly, we know if we put in place good habits into a business. So we're going to build a forecast. We're going to move money twice a month. We're going to put money in the profit account. We know we're confident that in a year's time, that business is going to be in a very different position. So if you're worried about making payroll, if you're worried about making VAT, if you are wasting your precious mental bandwidth and kind of fighting those battles and being on the hamster wheel, well, then we want to get that sorted for you so that your firepower goes on building a great business, building the brand, doing the marketing, delivering a great product, increasing your prices, having cash in the bank.
Let's talk about forecasting. What do you see from a lot of the clients that come to you that are either like brand new or established? Are they forecasting, and then what habits do you get them into?
They tend not to be forecasting, and if they are, they might have a revenue figure in mind. And what we try and do is break that back into, what does that mean for members? How many more members do you need? What about your churn? What about your pricing? What about your groups? And just do a very simple, we actually do our modeling in Excel. I love tech, but there's not a better answer than Excel, which has been around for 20 years, 20, 30 years.
And you've explored it. I know that.
Oh yeah, we've explored it in a great deal. And actually, you can't beat a simple spreadsheet. So we have a template that we use with our clients that allows us to kind of work that up. So we're trying to tie in to the reports that we give our clients up, have both the financial data and the non-financial data, because the two have to tell a story. The two have to be joined and mean something. And so that if you've got an aim to bring on 10 new members, that puts you on target for your year-end profit figure, that puts you on target for your 5-year plan, that puts you on target to buy that house or have that holiday. And we're just breaking it back into micro steps, so month by month, so you know what you got to do, so you can get focused on it and push it forward.
Let's talk about someone, a business owner, wanting to secure their first property or a second property. How do you advise them on that personally, using obviously the finances from the business?
So in terms of acquiring commercial premises?
Yeah, or personal. Yeah,
okay. There are a few options around commercial property and tax efficient vehicles, typically pensions. So if the business is making profits, put money in pensions, and then the pension can then borrow money to buy premises. That's a great that's another business in its own right. Because you can then sell your trading business but still get rental income.
We have a number of FMA members that have progress to buying the premises. Either they buy the existing premises they're in, or they just move a few units in the same area and they buy that premises, and suddenly they're a landlord to their own business. They're in the commercial property.
That's great. You're then playing a different game. You're then in the property game, and you need to go in with your eyes wide open.
What would you need to show to the commercial mortgage companies? Like, how would you set your business up if that's the goal, right? In 5 years' time, my lease is up. 3 years' time, my lease is up. I know I don't want to be paying 3,000, 4,000, 5,000 to someone else. I want to get my own commercial property that I pay the mortgage on.
Yeah.
How would you advise and help on that?
The mortgage brokers want to be able to see that the business can service the debt. So the first thing we want to get a sense of as well, what's the value of the property you want to buy, and then we can work backwards to see what the level of profitability is that you need to support that claim, that ambition, and then it's about delivering the membership numbers to get it over the line.
And then personally, I want to buy my first house. I want to buy a second house, maybe a third house as an investment. How would you advise me? Would you tell me to take more from the business in my salary to get that first mortgage or second mortgage? What would be your opinion?
Do you know what? It depends on the lender. Some lenders want to see that an individual has a good chunk of income on their tax return. Some lenders are more relaxed about a lower figure on the lower amount of personal income and a high performing business. But we can put our clients in touch with a mortgage broker who can help them get a deal on the table.
And then work backwards to
achieve it. Yeah.
Let's touch base on pensions. Should gym owners, business owners, be contributing to a pension, or should they just worry about that in the future?
A pension is a great tax efficient vehicle to save some money. It depends on the individual, but my instinct is that if you're not saving for a pension, you're missing a trick. I think you have to have a very good reason not to do it, given all the benefits of saving for a pension. It should be part of your planning. Maybe it's not the only thing. Maybe you've got shares and property and your business, but I wouldn't neglect the power of the pension.
Well, I think some of the terminology might be, I'll do that when I'm older, or I just want to put all the money, reinvest it back into the business to grow a bigger business, that eventually I'm going to sell, but obviously that might not happen. So you're advising people to start that pension, or if they've started it and then stopped, definitely look to contribute.
Just start it. Yeah.
Just break this down. How often do you have to contribute to it? How much can you give? What's the max? What's the minimum?
So you would invest monthly. You can invest up to, the limit used to be £40,000 a year. Actually, it's just been significantly increased. So I mean, very few people have to worry about hitting the upper end of pension contribution limits. If there is an issue you have, then you have a nice problem to manage. But we work with an independent financial advisor, so we can work out, well, if you want a certain income from your pension, this is the amount of money you need to put in. But certainly, it's just starting that habit of, if you haven't got a pension, just start putting in. I would suggest anything less than £100 a month. You need to ask yourself, is that business really delivering for you what it should be?
And the max is 60?
60k, yeah.
And with the pension, what are the benefits for me as a business owner to contribute to the pension?
So the money comes out of the business. You then get corporation tax relief on that. So corp tax is between 19 and 25% at the moment. So your company puts £100 in a pension, it pays broadly £20 less corporation tax every year.
And why does the corporation tax vary from 19 to 25?
It used to be a flat rate of 19%. It's just been increased since April this year to 25%, but that kicks in at 250k worth of profit. So depending on where your profit is, you'll hit a grade between 19 and 25%.
I think a number of business owners fall into that trap of I run as much as I can for personal expenses through my business. So I'm going out for a meal with my boyfriend, girlfriend, husband, wife. I'll just put that through the business. Or I need to buy some new training kit to work out in the gym. I'll put that through the business because I'm in the fitness industry. And then suddenly, I need to go on holiday. I want to go on holiday. I want to go to Dubai. I'll put that through the business and then say that I was there for a business event or a trip to check out other gyms. What's your opinion on that?
We have to be really careful about that. I mean, the rules are black and white. If you have a tax inspection, the inspector will not take kindly to meals out with boyfriend, girlfriend, husband, wife going through the company, and they will recalculate your tax and potentially penalise the company. So we want to avoid that. There is a grey area. So for example, let's say you're going to Dubai. Let's say there is a conference out there. There are rules where you can put some of that cost through the company, but if you to put the whole thing through and take your partner and your kids, that's not going to fly.
Tax inspections, what's your experience of them? How often do they happen? What's the process?
So you would just get a letter from HMRC saying, we're coming out to see you on this date. Please prepare this information. And with our clients, because we use Xero, because we use software, so all the data is online. We can just give a tax inspector a login and say, there you go and fill your boots. The process, if you haven't got that information already, the process will be painful. And to the extent that the tax inspector can't get comfort that things are legitimate business expenses, you can expect them to disallow them and potentially penalise you. So inspections are fairly uncommon, but let's say you're building your business because you want to build something of value. You want a legacy. You want to sell it at some point. When you're selling it, that's one of the questions you'll get asked. When was your last inspection? Because whoever's going to buy it, they're thinking that they're going to get inspected on the company they've just bought. And so if what you've created isn't clean and tidy and well organized, the value of it has just gone down.
In the UK, osteopaths, chiropractors, physios, massage therapists, dietitians don't have to pay VAT. And then gyms, personal trainers, fitness instructors, people that teach classes, they do have to pay VAT. I believe that's unfair because everyone I listed, osteos, chiros, etc., and personal trainers, gym owners, they all have one common goal, which is to help people. Will that ever change? What's your viewpoint on it?
I don't think it will change. The reason that the osteos, etc., don't charge VAT is that they're exempt from VAT because they're medical supplies. HMRC are not going to give up their VAT on fitness sales in a million years, even though totally understand where you're coming from. You're delivering the same outcome. HMRC, the VAT rules are complex. The UK has the biggest tax code in the world. It's quite easy to make a mistake on it.
It's crazy because the obesity epidemic, issues with mental health, people need to be exercising, people need to be connected to a community, they need to be coached, they need to be held accountable, they need to go to a gym or at least work out. And the UK government, the NHS is in trouble, and medical services are at a bursting point. But then at the same time, the UK government are charging VAT to gym owners.
If you're asking me to justify the UK tax system, I'm afraid I can't. There are plenty of examples where it doesn't make sense, and we have to take the view, them's the rules, because we want to make sure that you're not going to get that penalty. You're not going to ultimately deprive yourself of value because there are compromises in your business because you didn't like the tax rules. We just have to observe them, I'm afraid.
In all your years working in this industry, what have you seen where someone's gone to court and then prison because of tax avoidance or unpaid VAT?
A more likely scenario is where someone's borrowed money from their company, they've traded when they shouldn't have traded, and the company's then gone bust. In that case, the insolvency service get involved, and we've seen clients get into that situation, and what ultimately happens to them is they get disqualified as a director. So for 5 years they can't be a company director, and they are at risk of prosecution.
So they own a business, they secure, let's say, a loan, $250,000.
Yeah.
Then that business fails.
Yeah.
They can't pay back that $250,000.
Yeah.
Then what was the next bit?
So if they'd secured that loan under false pretenses, if they'd filled out the form to the finance company saying that the business was fine, but they knew that it wasn't, that's when they're at risk of getting disqualified. Taking out a loan and being unable to pay it because of trading, it happens all the time. That's not criminal. That's just business. But if it's very clear cut that actually the director behaved in a way that they knew they shouldn't have, then there are the risks of getting disqualified, and in really serious cases, and it is rare, really serious cases, prosecution.
Let's talk about Companies House, registering a company. At Fitness Marketing Agency, we have a ton of competitors. They pop up, they run a few Facebook ads saying they can help gym owners, and then you never see them again. But unfortunately, some gym owners go and use those said companies, and they're not legit. They don't have a very good product, don't really have much social proof. And if you were to research them on Companies House, like they have like 10 companies, like it's crazy, and none of them are making money. So my question to you is, if someone in the fitness industry, fitness space is looking to get some advice and pay for it from a consultant, a business owner, a marketing agency, how can they really just investigate that individual via Companies House to see that they're a legit business?
Yeah, it's a really good question. Companies House doesn't give you a huge amount of information, but the accounts for that company will show the company balance sheet. They won't show the profit and loss. So you can't see sales and profit, but you can see what the cumulative profit over time, either the net assets of that company are. So these fly-by-night companies that you mentioned, they'll have only been open a few months. They won't have filed any accounts. Or if they do, and you download them, which is free by the way, all the information is publicly available. You'll see that their balance sheet has a really low figure, £100, £2,000, something really small. If someone were to do that to your company, they'd see a substantial balance sheet. That is black and white evidence of a company that's been there for a long time, and is building up long-term value.
If someone researches someone else on Companies House and they have like 10 companies, would you say it's a red flag?
Not necessarily. It could be. You can search by individual and you can see how many companies they've resigned from, how many companies they've been removed from. You would have to take that information in the round. It wouldn't necessarily indicate anything's particularly wrong, but it's you could take a view based on what else you can find out about that individual and those companies.
This conversation's been insightful. I'm sure people listening or watching this will take information. For me, the takeaway is be profit focused.
100%.
Where can people find out more information about you?
They can go to our website, cloudaccountant.com. They can book some time on my diary. They can download materials from our website. We love talking to entrepreneurs. We don't go in for hard sell. We just want to talk to people and give them resources and start a conversation. And if we can work together, then great. And if they do one thing, we just want people to use Profit First. Okay, you can use it in your business. You can keep your current accountant. Just open that bank account, call it profit, put 1% in, see what happens. You'll be amazed.
There's too many businesses, there's too many fitness businesses not making enough profit. It's people like you and Mike who are driving that message to business owners and entrepreneurs. And I'm driving it in the fitness space as well. I highly recommend anyone listening or watching this goes check out the website cloudaccounting.com.
Cloudaccountant.com.
Cloudaccountant.com.
That's actually.
Have a chat with Duncan, and he can massively impact you like he has with me and Fitness Marketing Agency. Thank you, Duncan.
Thank you, Ben.
Thanks for listening to the Fitness Marketing Agency podcast. If you enjoyed it, make sure to subscribe so you can catch future episodes.